Hi there, this is Eric Boyce, CFA, President and CEO of Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for May 7th of 2023. See our disclaimer for important information. Last week, we've had several pieces of very important economic data, and obviously what you're looking at is the Fed funds target rate, which we had a very important Fed announcement this week. We also got the April ISM, Institute for Supply Management Non-Manufacturing Index, and we got the April employment report. And so we're going to talk about the employment report here coming up. We have lots of slides on it. I'm going to get to the rate increase, but I wanted to hit real quickly on the April ISM, again, non-manufacturing index. That's the service sector. And so activity actually grew modestly in April. 14 out of the 18 major industries reporting growth in that ISM services number. We had new orders and business activity a bit mixed, but still positive. So we still see this continued shift of activity, both from the business and consumer side, away from goods and towards services. And so, as we're talking about this potential for recession, it's not likely going to come from the service side. It's likely going to originate from the manufacturing side, which we know is clearly slowing down. We see that data really softening up, but employment remains strong. We'll get to that in a second. But prices paid, prices index within this ISM services number has been trending down, but it's still a major problem. And so we're going to have to continue to monitor that as it relates to Fed actions. As it ties back to this chart here, you can see the meteoric rise in short-term rates. We did get another quarter point here. So this all ties together, of course. And so as we just alluded to, we did get the FOMC, the Federal Open Market Committee decision. They did raise short-term interest rates by another quarter percentage point. So the range is now 5 to 5.25, and that was every bit in line with expectations. No surprises there. Now the disconnect comes into play here when we look at the forward curve and what that looks like. And we do have some slides on this, the expectation is that we're going to have some rate decreases, probably about 3 or 4 quarter point rate cuts by the end of next January. That's not anywhere near certainty. In fact, the Fed, their own estimates by way of their what they call the dot plot do not confirm that. This is what the market's pricing in. So this is the big disconnect right now. And, it's entirely possible with some of this lingering inflation data, which is kind of stagnated a little bit. We still see inflation coming down, but it's going to take that the labor market softening and wages to soften up to get more momentum in that downward sloping inflation trend. But there's still a reasonable possibility that the Fed will raise rates at least one more time before they pause. Now the market's pricing in a pause right here, so we'll see this coming up in a second. But the main thing I want to focus on in this next slide is the money supply, which I've been talking about a lot over 2023 and how is dramatically decelerated, and there is a extremely strong correlation to slowdowns, and even at this point we're negative on money supply growth, and that's the steepest drop that we've seen in multiple generations, and so that has the potential of really not only slowing inflation, but slowing the economy as well. So we're going to look at that here coming up in the next slide. But Fed funds target rate moving higher to 5 to 5.25. Here's a chart that I was alluding to. What you have here is an overlay. You've got in blue, it's the M2 money supply year over year, and we've accelerated this forward by about 15 months because there is a lagged effect on what it does to the CPI. And so this is what I was talking about in that prior slide, that the money supply, when it does slow, and it's negative now, and this chart is actually a little dated. The money supply growth on a year-over-year basis is actually closer to -4% now, -0.5. But again, this is from February. But I wanted to show this because it was illustrative in the sense directionally that we see that CPI follows. And so it's important to know that, that the money supply deceleration will definitely help inflation, but it just takes time. Here's a couple of charts on interest rates that I think really paint the picture for us right now as we kind of like anticipate this recession. And looking at the left-hand side, we've got the difference in the 2-year U.S. Treasury rate versus Fed funds. And so we see that that delta, essentially Fed funds, is a full percentage point greater than the 2-year Treasury rate. And that's a short-term inversion, but we also have the longer-term issue here. We got the 5-year government bond yield about 3.3, and as I said, Fed funds is now in a range of 5 to 5.25%. So, we're almost 2 percentage points when we get out to 5 years. And so, yield curve all across the range of maturities going out 30 years is inverted at this time. Here's a quick check. We've got a couple of charts here on the banking sector, and we continue to monitor this. It still remains an interest. Obviously, Silicon Valley, Signature Bank were what we were talking about in March last month, and then into this month. We're talking about First Republic, and so we had that deal for J.P. Morgan to come in and take those assets. But you see here, the real issue. And so it's not credit quality that's been the problem. In fact, credit quality has actually hung in there pretty well. We do see credit quality on bank loans eroding, just a little bit, but you would absolutely expect to see it, but not nearly as much as you would expect in the depths of a recession. But here, the issue is rising rates. And as you saw in that very first chart, short-term rates went up at a meteoric rate. And that is highly unusual, much faster than in prior rate tightening cycles. And the result of that is you've got significant declines in held-to-maturity securities, which a little bit more long-term assets, if you will, or investments, I should say, and then you've got available for sale securities, which are deemed to be a bit more liquid, but you've had declines in value on both of those, and you can see that those have been building and compounding over time. Here's a quick survey from Gallup talking about the safety of money in banks. And I thought this was interesting because you've got essentially, about half of the population, half of these respondents say that they're either very worried or moderately worried about the safety of money in banks. Now, the Fed has gone to great lengths, as well as the FDIC and the major regulators, to assuage these fears because of the quick reaction to Silicon Valley and Signature Bank in those bailouts. And so, the other half is not terribly worried because they have bought into this notion that there's a too big to fail that extends to even some of the smaller banks. But I do think we're going to have continued and ongoing stress at the small banking sector. Not only, for this chart, which is kind of the, obviously this is a presumption on the part of individual respondents, but those people talk with their money and talk with their decisions to move money out of small banks and into larger banks like Chase and Wells Fargo. So that could certainly happen. But then on the other hand, you've got, the bank balance sheet problems that you saw in that prior chart. So here's a leading indicator chart. We've got conference board data, and you can see that this overlays actually, depending on your perspective, actually quite nicely from a statistical point of view over recession. So when you see these declines in LEI, and this is actually the spread of LEI between the leading and the coincident indicators. And so not only is the LEI rolling over, but you see that spread widening between the LEI and the coincident. So usually coincident indicators will catch up at some point. And so this delta is kind of foreshadowing this next recession. That is, again, it's an indicator that has very strong predictive power, but by the same token, it shouldn't surprise any of us because this is, in recession when it does come, will be perhaps one of the most anticipated recessions in the history of the U.S. Non-farm payrolls. Well, we're going to jump right into this April employment report. So non-farm payrolls, we had increased 253,000 in April, which beat the consensus estimate of 185,000. And the unemployment rate ticked down to 3.4%. We've got that data for you. We've got a lot of charts coming up because this is kind of an interesting inflection point, I think. You can see the trend line for payrolls looking down a little bit. Now, and the other thing I want to caveat here is that we had significant revisions for February and March that were to the downside. And so payroll gains for those 2 months were revised down by about 150,000 jobs. And so the net gain, if you look at it from April relative to the prior 2 months, is only about 100,000. So I would say that these gains are, when you look at the body of data, not just a headline figure, that improvements in the labor market are clearly slowing, and probably expect that to continue and to intensify perhaps as we head towards the summer and certainly the fall. But we've got wages that we're going to talk about, and wages are down relative to prices over the last year. So there's still a negative real wage effect going on. And again, I think there's a lot of impetus for slowing in the labor market, which frankly is one of the things that the Fed is trying to engineer as part of its dual mandate for price stability and stable employment. Here's the unemployment rate. We're at a 53-year low at 3.4%. You can see that downward trajectory. This is getting us back into that, in fact, below that pre-pandemic level. You can see here again, shaded areas represent recession. So, not too surprising to see this on the eve of a recession. Here's a share of the prime age population, either in the labor force or employed in the labor force. And obviously, the prime age, as you can see here, is 25 to 54 years old. You can see the blue line here, the labor participation rate for that particular age cohort has picked back up and is now at pre-pandemic levels. This is a sign of wages being strong enough to incite people that went on the sidelines during the shutdown and during the pandemic to come back into the workforce for this particular age group. And you can see the employment rate is moving higher as well. And so, a lot of this is, riding side saddle to these wage gains. But the more people you get back into the labor force, the more over time it should temper wage growth and get us back into a more normalized and perhaps pre-recessionary mode here as supply and demand takes hold. More workers in the labor force, more supply of labor should bring those costs down somewhat. Kind of the internals of the jobs report, we can see change in employment by sector. So as we dissect this number and see how, where the strength is coming from, obviously it's not in food, government, entertainment, the retail side of things, or particularly real estate, but you got to go upstream and look at the top of this chart where we have healthcare, transportation, warehouse. Again, these are in some respects highly skilled positions, in other respects semi-skilled, warehousing, professional and technical, including even in the kind of the software elements, where we've seen a lot of layoff announcements, particularly coming out of the Challenger Gray Christmas surveys, which tend to focus on more larger companies. And so we've seen a lot of layoff announcements. But when you dissect the broader economy, and as we know, the majority of the economy is represented by smaller and medium-sized businesses. Here we see these pockets of strength that are kind of lingering here, which kind of confounds the Fed in their decisions to raise interest rates. Here's the employment level, as we see here, as I just alluded to in the prior slide, that we're back above the trajectory that was established before the pandemic. You can see that bounce back following the shutdown of the economy and this kind of almost rather boringly linear progression in the employment level. But you can see the slope, again, represents a rate of change, and that slope is beginning to decelerate here. And on the right-hand side, non-farm payrolls on a 3-month moving average. You can see this deceleration. This is what I was referring to, that that we see the improvements in the labor market are clearly slowing down, and this is very consistent with the environment that we expect to be heading into. Here is the Challenger gray announced job cuts. That is a 3-month average with on the left-hand margin there. This is year over year. That's in the kind of this light aqua blue here that you see. A spike, even though the latest reading was down off the peak, but it's still extremely high for a data series that goes back to 2005 here. And you can see the oscillation, the slight bump during the global financial crisis. The pandemic was obviously very much an anomaly, and then it had its very wide oscillation there. But clearly the numbers are high. And so the read-through on this is that jobless claims on a year-over-year basis, again, a 3-month average in that dark, in that black line there, is apt to pick up and follow where the announced job cuts are going. So we do expect deceleration in labor. We do expect increased jobless claims. We do expect a reversal in the trends that we're seeing in the unemployment rate. Here is the average weekly hours of private sector employees. We see both from a non-managerial standpoint as well as all private. And so really the focus probably a little bit more on non-managers because it represents a much broader subset of the labor force here. And you can see these trends, particularly in 2023, on the downslope, we got average hourly earnings, also in some deceleration. And this is a trend that was already manifesting even last year. And so some of these trends, take a little time and kind of lay under the surface, and then, people start to pay attention to them. I mean, we've been watching a little bit of this deceleration for quite a while, but I would say that weekly hours, you can see the trend line relative to pre-pandemic levels is still above where it was, and average hourly earnings, as you see here, clearly remain above pre-pandemic levels, and as I just mentioned, still fall below the rate of inflation. So we're still in a real wage kind of a funk right now. Here is unit labor costs, which in some irony here are up. Now this represents benefits and the total package, not just the average hourly earnings. This is total pay, which includes benefits. So unit labor costs above the survey level, so wage inflation. Even though you see wages itself coming down, you see unit labor costs remain really sticky. And this is the part that really makes it hard for the Fed, because you've got wages and then you also have rents, cost of shelter. That those are the two sticky components of inflation that just inherently take a long time to come down. You see on the right-hand side, wages and PCE prices. This is personal consumption expenditure prices. So you see in the green line, you've got the median services PCE deflator. I would read that as kind of that embedded inflation number, and you can see how that's picked up. And then you have the employment cost index, again, which ties back to unit labor costs. It's a different calculation, but you see the ECI also moving higher too, and just remaining sticky. I mean, this is what we've got to work on for the next several months if we have hopes of bringing that inflation down. But as we talked about at the very opening of this, with money supply slowing and actually going negative on a year-over-year growth basis, these numbers will slow down. It just takes a little bit of time. Here is temporary help. We do see that that's rolling over, and as you can see, going back to the late 90s, is just not a lot of recessions to draw upon, and pandemic was a little bit of an anomaly. But clearly, if you look at the recession in 2001, 2002, and then the global financial crisis, that temporary help did roll over in advance of that. So this is a leading indicator of that recession that we've been talking about. Job openings, we do see job openings rolling over. Again, not surprising, as we head into the heart of the second quarter here in 2023. But we're still at this odd juncture. You can see the number of unemployed. So the number of job openings relative to the number of unemployed still remains relatively high. Again, most of these unemployed are in the low skilled or and most the semi-skilled areas. PCE, personal consumption expenditures, price index. This is the 12-month change here. So we see both the all-in number for PCE as well as the core continuing to attenuate, but well above the Fed's inflation target of 2%. This is the Fed's preferred gauge of inflation, not the consumer price index or CPI that gets reported very widely. But the PCE is important. It does tend to trend below the CPI, but again, it's still much higher than it needs to be. And I think best guess at the core level, or that by the end of this year, we're probably maybe 4%-ish on that number. So inflation will be sticky to come down, but again, the 2% target. And what this does is, it gives the Fed something to think about over the next several meetings. And again, they meet about every 6 weeks. So they'll have another meeting in June next month, in which they're going to ponder the rate of deceleration in this particular data series, and trying to come up with this whole plan of how are they going to, are they going to pause? Do they need to raise rates one more time? I think there's a very widespread consensus that they're going to pause. But again, with this number being as high as it is, you have to weigh the benefits of continued rate increases with the risks that you're going to drive a deeper recession, considering that money supply is negatively growing right now, and considering the fact that the transmission effects of rate increases take a while. They inherently, take anywhere between 6 and 12 months to really manifest within the broader economy based on historical trends. Consumer prices, this is the CPI number. So again, this is the number that gets reported in the headlines here. We can see the all-in CPI number coming off of its peak. And I mean, a lot of this, I call it the easy lifting piece of this came by virtue of, the commodities rolling over when things were in short supply, and we have the supply chain problems, 12 to 18 months ago, that really drove a lot of that inflation. That was the easy part. That basically, in a slowing economy, all worked itself out. But now we're at that point of the next the next series of gains from here are going to be incremental, and they're going to be a bit more laborious. Now, one item here which is very important to us all is the food component. So food prices and energy prices, which are the most volatile pieces of CPI. And again, those are the pieces that get pulled out when you report the core CPI number. But food, we know energy has come down a little bit, but likely remains somewhat sticky based on some factors which we'll talk about later. But food is definitely coming off, and this is one of those tangible things that when you go to the supermarket and you feel like, okay, maybe I'm spending a little less. That's just the inflation change that you can actually see. Quick look at high frequency data. We don't show this information that much, but I thought it was good to check in. We do have some interesting observations that I've highlighted here. Obviously, jobless claims. You can see that change month over month. We're having about 6.1%. And then looking down in some of the more industrial and manufacturing areas that we do see relative to 2019, we're still below those levels, but oddly enough, just like over the last month, we're up slightly in rail car traffic and steel production. That's, I think, some of the rail car traffic is driven by retail sales and consumption, which still remains stubbornly high, but we do see some deceleration. Steel production would be important for manufacturing, but those numbers are oddly positive. Expect those to begin to slow up a little bit, and then we get down to TSA checkpoint data. That has trended a little bit lower, and then obviously supply of motor gasoline, which if you're in an economic slowdown, you will definitely see demand for gasoline begin to trail off. Here we have CapEx plans for the NFIB, which is the National Federation of Independent Business. This is that trade group that represents smaller businesses. So you can see capital spending expectations are rolling over in the wake of the anticipated slowing of economic growth. That's in the top hand. In the bottom hand, you've got hiring plans. Again, this is very consistent with the data that we saw in the prior charts that I showed you. We've got non-farm payrolls continuing to move higher, as we just talked about in the employment report. But those gains are beginning to decelerate, if you will. They're not necessarily negative, but as is certainly being implied in this chart here, with capital spending plans rolling over and hiring plans rolling over, the non-farm payroll number is apt to roll over here fairly soon. Here's that look at retail sales, and I've kind of written the arrow underneath the 2023 trend as we overlay the current year with prior years. And I think you can back out 2020 just being such an anomaly. But if you look at basically the years outside of that, clearly we're in a trend line which is in deceleration. Crude oil futures, we do see that prices have moved off of their peak. Obviously, there was a lot of uncertainty during the initial phases of the Ukrainian invasion by Russia. Those tempered over time, and we saw that deceleration in pricing. But it's really firmed up here, and so Russia did pledge an output cut. OPEC looking at kind of like wanting to shore up prices at or near this $70 a barrel level, which I think is important for a lot of things. You got domestic production, which when you get too much further below, like maybe $65 a barrel, there's less incentive for drilling in a lot of these areas, not necessarily the Permian or the Eagle Ford, which have much lower overall per barrel operating costs. But again, it's important to kind of maintain this level. And my anticipation is, you have some weakness now because of the anticipation of an economic slowdown, which, as I said before, will inspire less overall driving and consumption of fuel. Monthly trade in goods and services, we see here imports have dropped a little bit, again, consistent with an economic slowdown. Exports remain fairly sticky, so we actually had a decrease in the monthly trade deficit last month. And as I show this here, we really haven't seen the transmission of a broader economic slowdown, that you'd see that would be associated with a globalized type of recession. So trade remains strong for the time being. Small business credit. This is important because this goes back to the small business sector, goes back to smaller banks that do a lot of the C&I or commercial and industrial loans. You could see here you've got in the gray line bankruptcy filings, left-hand scale there. Haven't really seen that spike up yet. You do see expected credit conditions, and this is the focus of this chart in that blue line in the next 3 months. And it's kind of advanced a year because it's a really strong leading indicator. And you can see there is a notable pickup here. Now, again, we haven't reached the levels that we saw in the global financial crisis where there was a near shutdown of credit for a while. But you can see here that credit conditions are clearly expected to deteriorate. And with that, you would expect to see an increase in bankruptcy filings, and again, an increase in credit stress overall. Continuing the theme here on the banking sector, I've got two pieces of information and a definite takeaway here. So in the blue line, we have an index for domestic banks tightening standards. And so again, for C&I loans, and we know that a lot of the C&I loans, the majority of those that are written, come out of the small to medium-sized banking sector. So as we've been talking about kind of this perceived stress in this sector and the confidence factor that we saw in that Gallup survey earlier in the chart pack, clearly, it's driving lenders at these banks to be more conservative in their lending. And so you see banks are getting tighter in their standards here. And so credit is less easy, if that is a term. But what's interesting here, and you overlay this with this red line, which is the high yield index. This is the U.S. high yield bond index. And so when you think about this and you see the tight relationship, the very positive relationship here, that we're going in different directions. So, high yield spreads are coming down, and you do see, high yield spreads consistent when, high yield spreads going down is consistent with a rising stock market. Well, we've had that a little bit this year, and so spreads are moving lower at the same time that credit is getting tighter. And so at some point, that's going to reverse and mean revert. And I do definitely see high yield credit spreads move higher in the wake of an economic slowdown. We'll talk about gold for a second, and then we'll move into the equity markets. Here we've got in this kind of dotted red line, if you will, it's the gold divided by S&P 500 price. So gold prices divided by S&P 500 index levels. This is a ratio that gets followed quite a bit. We do see gold back in favor. It's over $2,000 an ounce. I think it probably has upside to maybe 2,200. We're taking a higher profile on gold exposure right now ourselves, and you can see here that the gold over S&P 500. Again, when this red line moves higher, that means gold is stronger relative than stocks, and we see the net speculative interest here. So there's a lot of people moving into gold at the same time that prices are moving higher. It's kind of a self-fulfilling prophecy. Prices moving higher is going to get more people to jump into this, and at a time where I think we do expect some volatility in the stock market. Well, that brings us to this slide. We've got a red and a green arrow, and there's definitely a takeaway from this. So on the left-hand side, you've got real GDP estimates. You can see the clear deceleration in the actual and observed data over the last several quarters. And you've got the estimates for the second quarter, rather anemic, about 0.3%. And then we go negative for at least a couple of quarters here. And that is the consensus estimate. And then when you go over to the right-hand side, you've got the S&P 500 index. Again, these are estimated stock earnings, quarterly earnings for the stock market. And they're going the other way, and you generally don't see this. So obviously the stock market is a subcomponent, if you will, of the broader economy. And if you're expecting economic growth to be tepid to maybe even going negative, you wouldn't generally expect to see rising quarterly earnings. So there could be a disconnect here with these earnings these estimates being a little too high, apt to come down. We're already tracking on a year-over-year basis a negative trend, but especially looking in the third and fourth quarter, these estimates just might simply be too high. Having said that, earnings typically do go down about 10 to 20% during recessions, and this has a lot of recessionary periods represented on this particular chart, going back to the Great Depression, 1929 being the earliest data point on this chart. But you can see in that blue represents the average, if you will, from peak to trough. And again, we're already off peak earnings, so we've already kind of tracked some of this decline. Now, we haven't seen outright negative earnings growth, or what we call like an earnings recession, if you will, and that may very well come. Again, the last chart was not necessarily suggestive of that, but sometimes earnings estimates take a little while to recalibrate, if you will. But clearly, there is a data that shows us that we're going to have earnings stress. So the next question is, what do you do during that time? Well, obviously there's things that you do proactively to de-risk your portfolios. One is to prepare yourself for the fixed income market that we have. I do believe bond returns are going to look better this year. Certainly already have thus far. And you position yourself a little bit more defensively on the equities that you do own, perhaps own a little less equities. So these are all things that are at play in our thinking. And then I've highlighted a couple of factors that tend to perform much better. And these are factors that actually have performed. So this is anecdotal data looking back over April, but these particular factors generally perform much better during economic slowdowns, and they actually worked really well last year. High dividend yield, as well as quality and financial stability, capital strength, all of those there. You see low valuation, so more value-oriented companies tend to work better. You see down in this chart here, growth did not work well this particular month. And then high volatility, and those are factors that don't work well. But again, highlighting the ones that do: low valuation, yield, and quality. Certainly, given you enough data to perhaps be a little bit more circumspect over the near-term prospects of our investment markets. But there is a silver lining here. And that is represented on this chart, and then perhaps the next chart coming up here. We've got, a lot of data that tells us that when you get into kind of the last half of a recession, equities start to perform and move higher, anticipating the next economic cycle. And so that's what's represented here. And I've highlighted, again, the last 3 and 6 months of a recession. You typically get a reversal of what you see during the first few months, and that's clearly represented on the left-hand side here. But I think the silver lining is that, yes, I think as we begin to really gird ourselves for this downturn, in equities and earnings and all the things we've been talking about, move a little bit lower in response to that. That patience is a virtue, because then you get to that midpoint or whatever, and you see the other side of this, and you can actually have some really strong equity performance numbers coming out of a recession, and you just don't want to be not invested at that point, so you miss it. And this chart represents what I just mentioned here. So equities generally down before a recession, but then have some rather notable gains 6 months after. And again, this is 6 months before and after recession. You see the declines in blue here and the gains in red. And again, some of these gains, when you look at these prior periods, these prior episodes, can be rather dramatic. And then on the right-hand side, you've got an average S&P index performance looking out 2 years after a recession. And that number, as you see here, is about 20%. And again, you've had some really notable, strong gains after recessions. And so, again, patience is a real virtue. that this is the, obviously these more turbulent times and uncertain economic backdrops, create some anxiety for investors that, from a behavioral standpoint, behavioral finance is really strong in this regard. It inspires you to do things that are kind of counterproductive to what a long-term strategy should be, and remaining steadfast to that strategy, but obviously making the changes appropriately as you see data develop. And just like we looked at those factor analysis, don't invest in growth stocks if you're going to go into a recession. Be invested in dividend paying stocks and in strong company stocks. Those are the ones that are going to weather the storm. And then when you get into that midpoint, as you transition away from kind of the entry point, or the entry portal into the recession, and you can begin to anticipate when that recession is going to end, and you begin to move into that new market cycle, then you transition the portfolios away from more value into growth, where you certainly would anticipate there being that after the recession. And so that's where we are, and that's the virtue of active management and managing through these periods of volatility. I think I'll end on this slide, which I think gives us long-term perspective on everything that I've just talked about. That, if you go back to, in this case, 1962, and this is a logarithmic scale, so these returns are actually a bit more geometric and less linear than it shows here. I mean, they're geometric in the sense that they accelerate. And so there's a really strong response. This is the S&P 500, and I've highlighted these kind of pre and post recessionary levels, and the recessions are listed there in those gray bars. And so, at every time, every juncture where you're hitting that downturn, you're hitting that turbulence, the behavioral impulses kick in, you get anxious, you want to out of the market. And, it's so very hard if you do that to get back in. A lot of books are written on how to buy the market. Very few books are out there on how to sell it. But you manage around these turbulence points, and the markets always respond. And again, I want to really emphasize those last few charts. That, there's obviously a lot that I've said today that implies, has some negative connotations. We're slowing down. Labor's going to slow. We've got, industrial production. We've got manufacturing that's slowing, and services likely to slow at some point, and yada, yada, yada. It doesn't sound that great. And then, the presupposition that we're going into a recession, that certainly doesn't sound that great. But if you build your portfolio around what you see in the front windshield, and you look at this chart and understand the perspective of long-term markets. Again, most of our clients have long-term investment horizons that you just manage your way through the middle of it, and then you prepare yourself for the back end of it. And as I just showed you in the last couple of charts, that we tend to have some fairly strong responses coming out of this. And the mistake that people often make is that they get out of the market and they're very slow and hesitant to get back in because of this behavioral impulse, and they wind up missing a large part of that gain on the back end. So again, be unemotional, be steadfast, follow the investment policy, and and take stock of what's in the message that's embedded in this chart here. That's all we have this week. Hope you've enjoyed the chart pack. I look forward to visiting with you if you have any questions or comments. Otherwise, we'll see you again. Have a great week.